Perfect. Well, thank you to everybody that came and joined this webinar. I am here with Patrick Camuso from Camuso CPA. I myself, Cody, head of sales of Tundra Finance. Today, what we are going to tackle, and mostly what Patrick's going to tackle, is the revenue procedure on 2024-28. So with that, I will pass it over to Patrick, and we can go from there.
Thank you, Cody. I appreciate it. And, I'm happy to be here today. From my perspective, this is one of the most significant accounting changes since the inception of cryptocurrency taxation and the IRS's guidance back in 2014. So I think this is a very important and relevant topic, and I'm excited to get into it here.
Perfect. Yeah. I know that this is going to be just chock full of great knowledge. And, with that, I will kick it off.
So very briefly, a little background on myself. I'm the managing director of Camuso CPA. We're a CPA firm that's based in the United States that works nationwide with both investors and businesses that are transacting on chain. We assist them on both the accounting and tax side. And we've been doing that since 2016. So we were, one of the early firms in this space and have been growing with the industry ever since. Additionally, I'm the host of a podcast called The Financial Frontier. There we cover tons of regulatory updates like this revenue procedure we're going to discuss today in a timely manner to keep you up to date. Additionally, I'm the author of the Digital Asset Digest, where we cover similar topics in even more depth on that newsletter. So be sure to check those out.
Perfect. And, before we move on to the next slide, I know you've been involved pretty much since the inception on the accounting side of things. Typically, who do you work with? Just so our watchers get a sense.
Definitely. I would say there's two big groups that we work with. One would be individual investors. These are usually going to be higher net worth with extremely complex portfolios. They're coming to us for one of two reasons. They either can't manage the accounting and all of the associated data issues with their transactions, or they're just not really clear on the tax implications associated with some of their transactions. And that's where we assist individuals. On the other side, we work with Web3 businesses. So think of businesses that are either raising money in crypto, paying their employees in crypto, getting paid in crypto, or a combination of all the above. Where we assist them is helping them select the technology stack to build out their back office, implementing the accounting function for them, managing that on a monthly basis, and then also assisting them with any related tax needs when it comes to both tax planning and tax preparation.
Perfect. Yeah, no, and for all those listening, if you need accounting help, Patrick is one of the best to do it. And, kind of with that, we'll keep the train moving.
Definitely. So I think it's important to put into perspective, why are we dealing with this revenue procedure? Why did the IRS release it? What problems are they addressing? And as you see here on this slide, there's two big issues that this revenue procedure is going to address. The first one is, as many of you are probably aware, I've done other webinars on this topic. I believe Cody has also done webinars on this with Tundra. The 1099 DA will be coming out in 2025. We've seen the finalized broker regs this past June. Right around the same time that those broker regs were finalized, we saw this revenue procedure get released. And it's because this revenue procedure is going to be extremely important when it comes to compliance with the 1099 DA. The 1099 DA is going to require tax reporting to be sent out by anyone that's deemed a broker, which, right now, for the sake of this conversation, let's just consider centralized exchanges. So each exchange is going to be reporting this information that is within their exchange, not from other exchanges. So basically, the 1099 DAs are going to be reported on an account by account basis. So that's the first reason why we're seeing this requirement for this shift. You don't want to have taxpayers reporting on a universal basis while these 1099s are going out on an account basis, because it's going to lead to a lot of compliance issues related to matching the third-party reporting with the taxpayer reported information. So by switching to this account basis, we're going to see a lot more congruency between the third-party reporting and the tax reporting that you may be. The second big reason why we're seeing this requirement is because in the past, under the universal method, taxpayers were sometimes selecting their accounting methodology in a way that can lead to abusive practices. What I mean by that is, under this universal method, what I've seen for years are people will plug in all their wallets, and for a given asset, they'll choose HIFO because a lot of times that's going to give them the best tax result. But a lot of times the audit trail that gets created using these accounting methods on a universal basis does not match the flow of funds on chain. You can have an example where someone's reporting a sale of Ethereum on Coinbase. The highest cost for the tax lot that they're selling is on Binance. So that cost gets assigned to the sale on Coinbase, even if a transfer didn't take place. Cherry picking your cost basis irrespective of the flow of funds, and also after the sale has taken place, was never really permitted. And it's always been my firm's position that you shouldn't be doing that. And we've advised clients not to do this for years. Nevertheless, industry-wide, we've been seeing this practice all the time. And the IRS has acknowledged that this has been going on and that it needs to stop moving forward. So that is the other big reason why we've seen them implement this revenue procedure, because now it's going to not only require the account-based calculations, but as we'll discuss, it's going to also require standing orders with brokers to prevent this cherry picking of the cost basis data, sometimes months or years after the transaction has taken place.
Great. Thank you for the why behind the change. I think that's going to be really impactful for those listening and even those that review this later on. I don't want to put the cart before the horse. I know you're going to talk about a lot of things coming up here, but I think one of the things that sticks with me most is how a lot of people may have to change their cost basis methodology if they are in HIFO. So with that, I'll continue here and we'll just take it.
Absolutely. So getting more into the transition from universal to account-based accounting. Let's just get into, what is that going to look like? I know I briefly explained it. Let's get into some more details. A universal accounting methodology is, if you've been accounting for your digital assets around this time or before, likely you're on a universal method. And what this means is that you may have Ethereum across 30 different wallets and exchanges. Under a universal accounting method, you're going to take all of those sources, plug them in, and apply an accounting methodology, not according to each account, but just according to each asset. So you may have Ethereum at 30 different places, and if you're applying HIFO, it's going to find the highest cost for that given period and apply it to a transaction that's a sale transaction. Again, this is irrespective of if you actually transferred that cost over to a specific account. So Universal is really not paying attention to where you're holding the assets. It's just looking at how many assets did you purchase across all wallets, all exchanges, and then it's applying an accounting methodology on an asset by asset basis. Whereas the account-based method, you're going to have to apply an accounting methodology to each respective exchange where you're holding an asset. And then you're also going to have to track any transfers and the basis associated with those transfers between accounts, meaning exchanges and wallets. So, that is the big problem with this universal method. The on-chain flow of funds and the audit trails that you create a lot of times are going to be mismatched when you're just applying the accounting on a universal basis. Now, when we go to the account basis, this is going to have audit trails that should be reflective of your flow of funds and should be much more accurate. Of course, one of the challenges with this is that it is adding to the complexity both of your accounting, but also of how you manage your funds on chain, because now there can be more significant tax implications to where and when you transfer funds.
Okay, perfect. And I guess like another question I have here is, we're a subledger. We want to make sure that we're setting our clients up for success. We ourselves have already put in place changes that allow us to help people with the account-based accounting. Have you seen that, all subledgers have this? Do you think that only a handful do? Can you talk to the software in general from your vantage point?
Yeah, because I have clients across many of these softwares, and that is something that I've been looking into. And what I'll say right now, it's a mixed bag. There are some softwares that have this account-based accounting in place. But I would say that right now they're very few and far between. And I would say even less have a feature that is going to help to systematize or automate this allocation process that we're going to have to do. So I think it's very important, like if you're working with a subledger right now, or if you're considering a subledger, you need to be asking these questions. You need to ask them, do you have the abilities to do the account-based tracking, or are we stuck with universal? And if you've already done accounting previously, you need to really understand what is going to be the mechanism for performing these allocations. So yeah, I've seen Entendre, you guys have the account base, and there's a couple others, but I would say many of them right now are aware of this issue, but actively working on implementing these new changes.
Yeah. Perfect. And then I know we're going to get into the safe haven a little bit, so I don't want to talk too much about it. But as far as, to your point, making sure that the solution that you pick has the ability to do this, right? We are coming up on November, which essentially is going to give people about 2 months before this account-based accounting procedures is due. The deadline hits on Jan 1. So, just making sure to everybody that one, the software supports it, but also your accountants are aware of this, because the last thing you want to do is be stuck in an agreement for 6 months, a year, knowing that it doesn't support the new requirements. Yeah.
Yeah, that's another thing that I'm seeing, especially on the Web3 side. I'm not working closely just with Web3 CEOs. Oftentimes they have a small internal finance team. And I was just speaking with two accountants at a Web3 marketplace, and I brought up this revenue procedure, and they didn't really even seem to be aware of it. And I think that overall right now, this isn't a topic that is being focused on heavily. We even recently saw that AICPA release comments related to these revenue procedures, urging the IRS to put out more marketing materials and announcements related to the revenue procedure. So I do think that this is flying under the radar right now. And to your point, Cody, we're coming up on just a matter of a couple months, really, several weeks, when you really put it into perspective on the timeline that you're going to have to comply with this. So it's just crucial to have that awareness and make sure that you're implementing a solution.
Yeah, and to your point about it flying under the radar, I found or heard stories that the IRS has always been very forgiving. So I'm sure that being under the radar isn't going to be a negative thing for certain businesses that aren't staying educated or up to date on the changes.
Yeah. This safe harbor, it was kind of, this whole revenue procedure was kind of just quietly put out there. And I've always thought that the lowest hanging fruit for an audit are non-reporters. But going back to the fact, like, my firm has always identified this universal method, and these after the fact accounting method applications as big issues and big audit risk, because it's creating inaccurate audit trail. So I've always thought this is the second highest risk for an audit, incorrectly applying HIFO on a universal basis after the sale has taken place. So, they're quietly having this revenue procedure go out in a couple months. You're going to be past the time for that. And then I believe the people that aren't aware of this are, more or less going to be on the chopping block.
Yeah. Yeah, and we can talk about this forever. I don't want to derail our flow too much. So I think this is a good segue right into the safe harbor requirements.
Absolutely. So, this is one of the most important pieces of this, because you're going to have a calculate. If you have assets pre-25, and you've been doing your accounting on a universal basis, you're going to have a calculated ending basis for each given asset in terms of units, and then the valuations that are going to be driven by whatever calculation method you chose on that universal basis. So that ending basis is going to have to be allocated now to each respective account where you're holding those assets, where you're actually holding those assets. So the way that this is done is basically you're going to have to first verify your ending holdings in your last calculation to your actual accounts and wallets. Those amounts should match. And then you're going to need to, following what's the language in this revenue procedure is following a reasonable methodology. You're going to have to allocate those units to those specific accounts. So maybe you have 20 Ethereum in your ending basis, but they're held across 5 different accounts. You're going to have to allocate them to those 5 accounts. In terms of reasonable methods, there are a few, and this may get too much into the weeds, so I'll just brush on this. The method that most people are going to use is going to be the universal method, which you're going to likely be going off of the dates of an asset and then applying either a HIFO or a FIFO allocation, or some sort of other methodology similar to that, to where if you have a bunch of assets sitting in the universal, you're going to have some systematic way to allocate them to each account, usually by dates, maybe following HIFO, maybe following FIFO. There is a specific identification allocation method as well. That's really only going to suffice for people that have already been on this spec ID approach. So I don't really think as many people are going to use that allocation method. Now, it's extremely important to keep records of your allocations. Firstly, the allocation methodology has to be documented by January 1st. And then you're going to want to keep documentation on what was your ending basis calculated on the universal basis, what is the methodology you use to allocate it, and then an audit trail that's just reflecting that allocation.
Perfect. All right, we'll go on to the next one here.
So the record keeping requirements are paramount with this, because that is really, if you get audited and you want to qualify for this safe harbor, it's really going to all come down to your records. So firstly, you need to have detailed and accurate records of all of your digital asset transactions, including purchases, sales, transfers, exchanges, and ending balances. And I think this can be one potential issue if you're just really learning about this now and you're thinking to yourself, all right, we're going to have to go and we're going to have to do these allocations. One thing I've seen throughout my whole career as a crypto accountant up to today, when I'm speaking to a new prospective client, a lot of times they'll come to my firm at Camuso CPA, and they'll either have been self-calculating, or they've been using another firm to do their calculation. And a lot of times I find material discrepancies in their ending cost basis information, sometimes within minutes, because there's just no due diligence done on it. What I find a lot of times is that people are doing their calculations. They're really harping on just making sure their gain or loss reporting looks good. There's no unmatched basis. They pay the least gains, and they're not really focused on due diligence on their full portfolio. One thing that goes overlooked is comparing your calculated ending holdings to your actual holdings on chain. When this goes overlooked, whether it's you miscategorize something, you double counted something, you're missing a wallet connection, this can lead to inaccuracies in your ending basis. I find these inaccuracies a lot, and what can happen is this is going to carry issues into future years. But now what's going to happen is when you go to do those allocations, if your ending balances are incorrect, you're gonna have to go back and rework all the accounting issues that are leading to those discrepancies before you can even start the allocation process. So, it's important to have accurate records leading up to the allocation. And then, of course, after you do the allocation, like we just discussed, to document that whole process. But, I can't harp on this enough. You're going to have to make sure your ending basis is accurate. And if you haven't been doing due diligence on that and doing this actual to calculated comparison, the likelihood that it is accurate quite frankly, I don't believe is that high for most people, especially if your accounting is complex. So the types of records, obviously, we're going to need a full audit trail from the original basis of the digital asset unit, the acquisition price, the purchase price, audit trail for everywhere that it was transferred to, and then how that basis is getting allocated to the actual accounts. So, this is very complex in terms of the flow of funds. And if you're out there still trying to do this in Excel or some back of the envelope way, it's not going to suffice. Number one, you're going to have inaccuracies. Number two, if you do get audited, the IRS is going to be partnering with a lot of these softwares and subledgers and accounting solutions that are out there. And you don't want them doing your calculation in a more sophisticated manner than you've originally done it when the burden of proof is on you to substantiate your cost basis data. I say all that to say that at this stage, you should be leveraging a subledger that has a robust accounting features that are going to be able to not only comply with this revenue procedure, but just give you the reporting that you need when it comes to your audit trails and your ending cost basis information, and help you gain greater accuracy by not just trying to plug this all into an Excel spreadsheet or use some other haphazard approach.
Yeah, and I think to that point, like I want to talk about two things. One, which is like the general value of good accounting in general and making sure that your ending balances are correct from a business standpoint. Like, I've always been a firm believer of making sure you understand your finances and your accounting impacts your decision making in the future. I mean, my wife hates it, but we treat our household income like a business. Like we have a P&L and we go over it every month. And I'm sure sometimes she wishes there was more in the expenses category, but there's things like that that we make informed decisions and businesses make informed decisions based on the data you have. So making sure that those ending balances are accurate just means that you may be able to give the business what it needs for growth or the next phase. And then the second thing, and keep me honest here, it seems almost like while this has flown a little under the radar, this is a chance for businesses to get their books in order and be in a really good spot so that come Jan 1, not only are they, essentially in compliance, but they can run their business to the first point in a much more streamlined and educated fashion.
Absolutely. And even to further that point, if you go through this exercise and you get everything up to date and you're in compliance with this revenue procedure, it could even create tax planning opportunities for you to optimize your accounting methodology on an asset basis and, across all these accounts.
Yeah. Yeah. And I mean, that sounds great. Anytime you can get a little bit of a tax break or anything like that, I'm sure you want to take advantage. So why don't we talk about some of the implications for the taxpayers here?
Definitely. So, the benefits of adopting this safe harbor is that it's going to protect you, number one, from penalties and interest related to non-compliance in the event of an audit. Right now, if you're going to stick with a universal basis and you're not complying with this revenue procedure, the likely result is that if you do go under an audit, your accounting is going to get recalculated under an account-based approach, likely with FIFO applying to the whole calculation. Depending on how you did your original calculation, this can lead to significant variances from your calculation, which are going to lead to tax adjustments. So obviously, we're going to want to avoid that. Also, like I was just alluding to, in complying with this revenue procedure, in leaving these standing orders with brokers, we can start to look at, what assets are you holding, what accounting method is going to be best for you, and start to really, optimize your overall tax position. So really the benefits of complying with this are going to be the tax planning opportunities and the risk of any audit related risks associated with doing the calculations incorrectly. And also, you're reducing your compliance risks because when you're reporting on the account base, you're going to likely have less matching issues related to third-party reporting, like the 1099 DAs. The potential drawbacks is that, this is significantly increasing the complexity and the burden on taxpayers to get their accounting right. You're not going to just be able to just toss everything into a software on a universal basis and run these calculations for each asset however you want. You're going to now have to do everything on an account basis. And just like we're starting to talk about some of these, cost basis issues that maybe people have been overlooking for years, these types of issues now are going to have to be addressed. So it's definitely requiring more sophistication and quality accounting for Web3 businesses and investors. In addition to that, on top of just the, new accounting requirements, because we're looking at everything on this account by account basis, your fund management across wallets and exchanges becomes much more important, because now you're going to have certain costs assigned on an account by account basis. So when you're managing your treasury, you have to be very careful of, if you're going to spend ETH on something, moving it from wallet A rather than wallet B can have very different tax implications. So this is going to create, new accounting requirements and just more complex management of your funds on chain. All of that really leads to the fact that this accounting has to be not only accurate, but up to date for businesses, so they can be making decisions on an ongoing basis that are going to benefit their business from a tax perspective.
So, and with that in mind, I mean, obviously, if you have a much more sophisticated business, multiple entities, tens, if not hundreds of wallets and exchanges, this is something that you really need to be on the ball on, because otherwise, to your point, the implications are much greater.
Absolutely.
Right. And, why don't we talk a little bit about standing orders and just overall non-custodial wallets?
Yes. So if you recall, when we were first going over, the why related to this revenue procedure, it's really two parts. The first part is we need to report on the account-based methodology. And this is going to serve two purposes. The first is the fact that the 1099s are going to be reported on an account basis. We want to match up to those. The second ties into, this account basis reporting, but now also this requirement of standing orders. And it's to solve this problem of people misapplying accounting methodologies and just cherry picking their cost basis after a sale has taken place, and a lot of times these audit trails not matching their actual flow of funds. So what the standing order requirement is dictating now is that for every broker, for every centralized exchange and anyone else that's deemed a broker, you have to contact them and leave what's called a standing order. That standing order, it can be left on an asset by asset basis, and you're going to have to explain to them and document with them the accounting methodology that you want to apply to an asset that's on their exchange, that you're transferring onto their exchange. So you're going to need to reach out to every exchange that you have and leave these standing orders with them and document them appropriately. That's step number one. With your non-custodial wallets, you basically have to do a similar process. Obviously, there's no centralized authority to reach out to notify of this, but you still have to document standing orders for each non-custodial wallet that you have that are going to dictate what accounting method are you applying for that specific account. So, the benefits of this, I think we hit on a little bit, is that we're going to be able to hopefully optimize your tax position. If we're looking at your current basis for a given asset and we're deciding on the standing orders to leave, we may be able to apply HIFO or Spec ID or another type of reporting for those assets, which can lead to a much better tax outcome for you. But it's if you don't leave standing orders, everything's defaulting to FIFO, and that's usually going to be, for most assets that someone's holding, at least historically, it's going to lead to a worse outcome. So it's extremely important that you document these by the date of January 1st, 2025. If they're not documented by this date, then, like I said, it's going to default to FIFO, which is probably going to be, the least advantageous accounting method for most people, for most assets. So one interesting thing here is how exactly to go about documenting these standing orders with brokers like a Coinbase, for instance. I've made my clients aware of this at Camuso CPA, but we haven't really went ahead and started documenting them yet because I'm kind of trying to see if they're gonna create like a new section under people's profiles or some sort of standard way for people to go in and make these selections. So we're kind of keeping that fluid now. We have a couple months to do it. I'm anticipating that they're gonna have to create some way for people to do this. In the event they don't do it, I think at the very least, contacting their support team via email with the read receipt at least create some form of documentation, but I'm really hoping it doesn't come to that, and I don't anticipate that it will. So I think it's very important to just keep an eye out for this. And one other thing I'll note on this is that when we're working with clients, a lot of times it's just very common for clients to like forget about a wallet or forget about an exchange, especially if it's not one that is heavily used. So, this is something that you want to avoid because of this deadline and the requirements associated with this. One way to avoid that is, going back to verifying your ending cost basis details. That goes a long way to getting more comfortable that the accounting records are complete and that you have all wallet connections. So, I think that's another big thing to just be stressing to clients is the fact that we need to do this for all wallets and all exchanges. So, go through that with a fine tooth comb and basically leave no rock unturned.
Yeah, no, and I think, a couple of things there that I think tie into things you said earlier is if you're doing this in a spreadsheet, I can't imagine that this is going to be scalable, especially when we get to the documentation of non-custodial wallets and standing orders. So having some software to help is going to be incredibly impactful. And I think too, as this continues to develop, having somebody like yourself that has expertise that stayed up to date with this since it started is going to be incredibly impactful as well. And I think, that's a good segue in here into working with tax and professionals. And I'll let you kind of take it from here.
Yeah, absolutely. Up to this point, we've just seen the regulatory environment, the accounting requirements, and just the overall complexity from a tax and accounting standpoint just continue to increase when it comes to digital assets and Web3. And as we move into the future, as the industry matures and as the regulatory environment continues to become more complex, I just see that trend moving forward and creating more complexity. So you definitely want to be not only on a robust accounting system, but working with tax professionals so they can ensure your compliance with these types of matters. I was able to reach out to all of my clients, and not only my clients, but even prospective clients in our industry at large to warn them about this revenue procedure ahead of the deadline. And, that is the type of value I believe that crypto CPAs and tax professionals can add to businesses. So a few things that they can assist with in this context is advice on ambiguities related to navigating this revenue procedure and beyond, because you'll quickly find once you get into this that this is the most granular, detailed consideration you're going to really have from a digital asset standpoint. And it's really going to put scrutiny on your whole entire accounting process, because now you're getting down to, is your ending basis accurate and how are you going to allocate it? So just navigating any issues that arise from that and that arise from the timing related to the deadlines with this revenue procedure is extremely important. And I think this leads into the next point, just accuracy and verification. We have worked with hundreds of investors and companies and have built in a due diligence process that can ensure a much higher degree of accuracy than just, doing this for the first time. And I think that's extremely important because a lot of these inaccuracies, like I was saying before, they can impact you when you're doing these allocations for the revenue procedure. And if they're not uncovered in a timely manner, they could even impact you in future tax years because you may have something incorrect on your basis and you may not realize it till 2 years from now when you sold an asset and your accounting system is saying that you don't have those units in your wallet. So just the due diligence and the accuracy verification of the accounting is extremely important. And then, documentation. You're going to have to do so much documentation related to the tax positions that you're taking, just in general for crypto, but specifically related to this revenue procedure, related to the allocation methodology, related to the standing orders, and just, navigating all of these brand new issues that even right now, everyone's navigating. The exchanges are navigating it. A lot of the accounting softwares are navigating it. So, having someone that can assist you with this, I think, is paramount. And lastly, I think I was hitting on this point a little bit, proactive tax strategies. I really pride myself on being proactive with my clients and, being able to reach out to them about these emerging tax issues like this revenue procedure, like on-chain sales taxes, like some of these other issues that a lot of times are going overlooked because there's so many competing priorities because we're out here on this financial frontier of, crypto and Web3. So I really think that if you're a tax professional out there or you're a CPA that's in this space, there is a lot of value that you can offer clients. And I think that your value to Web3 businesses and people transacting in digital assets is just going to continue to grow as this industry matures.
Amazing. Yeah, I think, we're seeing a lot of tax professionals move into Web3 because of the growing need and the growing requirement for this type of information. Now, we are kind of at the end of our presentation here, so I want to thank Patrick. But before we go, I want to see if anybody has any questions out there for Patrick or anything in general about us. Yeah. See. All right. Well, as we wait to see if anybody, let's see, we got a thumbs up. If anybody raises their hand, again, I want to thank everybody for coming. As you can see, both Pat and our contact info is on the slide here. We have been recording this. We're also going to include it on all of our major socials. I believe Pat is going to do the same. If you do have any questions, feel free to reach out to either of us. As we mentioned, Entendre is set up to support this new change in reporting. I would make sure that whatever vendor you're using does have that capability. And I want to, plug Pat here. He's been a great partner to us. Everybody that we have as a co-customer is extremely happy with his services. And clearly, he's incredibly knowledgeable on all of the changes and has his finger on the pulse. So again, thank you to everybody. I'll let Patrick say some closing words if he wants to. Yeah.
Yeah, so I just want to thank everybody for watching, whether you're here live or if you're going to see this on a recording. I hope you took some value from this today. And if you want to discuss this revenue procedure more, or anything really related to crypto taxes or accounting, I'm always happy to have the conversation. So feel free to reach out to me.
Yeah, and as we mentioned, the final thing I'll say is this is not common knowledge, or it doesn't seem to be at this point. So if you can make sure to spread the news of this, if for nothing else, to help the industry that we all love continue to grow, and make sure that nobody gets a bad taste in their mouth because they didn't know that there was a new accounting standard that was being put in place. So we're going to send out this video to everybody that registered. Again, share this, spread the word, and thank you again for the time.
Thanks a lot.
All right, cheers.